My name's David Hernandez. I'm a senior research analyst here at Marquette Associates, and I'm going to kick off the second half of today's Flash Talks by discussing the China A-share market. The China A-share market agenda for this Flash Talk is very simple. We're going to look to answer 4 questions. What are A-shares? Why do we care about them? What do they look like? And what is their future? I want to thank my colleague, Melissa Jursic, for providing this wonderful visual aid of her and the Shanghai skyline circa 2013. So what are A-shares? A-shares are Chinese companies that are listed and traded on the local Chinese stock exchanges. There's 2 stock exchanges, the Shanghai and the Shenzhen. Over the last 15 years, the number of companies listed on these exchanges has grown from 1,500 to just over 3,500. As a point of comparison, here in the United States, between the New York Stock Exchange and the NASDAQ, there's just over 4,000 listed companies. Now, historically, the A-share market has been closed to U.S. investors and other foreign investors, so we haven't been able to transact in this market very easily. But that changed in 2013 when China announced its Stock Connect program. And that program looked to open up the A-share market so that foreign investors or investors outside of China could transact in that market. Now, that event was a key reason why MSCI this year in 2018 added a small piece of A-shares to its MSCI Emerging Markets Equity benchmark. Now, that's a benchmark that many of you have and you see in your client reports on a monthly and quarterly basis. So if A-shares were just added in 2018, some of you may be wondering, what is it that I hold in my emerging markets equity China exposure? And the way that I would describe what you hold is it's an alphabet soup of share classes with a side of chips. So you have B shares, ADRs, you have A shares, you have H shares, you have P chips, you have red chips, okay? As a reminder, A shares are Chinese companies that are listed and traded on the local Chinese stock exchanges. Red chips and P chips, these are Chinese companies that are incorporated outside of China and trade outside of China. ADRs, these are Chinese companies that are listed on overseas exchanges. So a great example of this is Alibaba, which trades on the New York Stock Exchange. H shares are Chinese companies that are listed on the Hong Kong Stock Exchange. And historically, H shares is the main way that U.S. investors have accessed Chinese equities. And H shares represent that old investment opportunity set within China and the old economy. A shares represent the new investment opportunity set in the new Chinese economy. So for the rest of the presentation, we're going to focus on comparing these two, A shares and H shares. So to start, there are companies that are listed in both markets. Now, why would a company list in both markets? Well, historically, if a CFO wanted access to foreign capital, she would have to list on the Hong Kong Stock Exchange. And if they wanted access to Chinese investor capital, they'd have to also list in the A-share market. And as a result, 80% of H-share names also are listed in the A-share market. Now, in contrast, only 20% of A-share stocks are also listed on the Hong Kong Stock Exchange. So there are more unique investment opportunities within the A-share market. Now, we're going to continue to cover the differences between A and A shares for the rest of this presentation. But for now, let's talk about why we care, or why we should care about the A-share market. And one of the reasons why we should care about the A-share market is that small piece of the pie up there, 80 basis points or 0.80%. That's the number that MSCI added to its MSCI EM index in 2018. Now, MSCI was not the first to act in this regard. Vanguard, in 2015, one of the world's largest index fund providers, announced that they would include A-shares in their Vanguard Emerging Markets Equity Fund. And as of June 2018, A-shares constituted 6.9% of that EM index fund. So we care about A-shares because it's being included in institutional portfolios as well as institutional benchmarks. And we do expect that to grow over time. Now, speaking about growth, China's contribution to world GDP growth has ballooned over the last 35 years. If we look at 1970 to 1985, China's contribution to GDP was 3%. Between 2000 and 2017, China's contribution was 27%. So as the Chinese economy continues to expand, we would expect the A-share market to continue to grow. And that market at this point in time is already sizable. If you look at the market capitalizations across the globe, China is second only to the United States. So you think about established exchanges in Tokyo and London, those markets are actually smaller than what you see in China. Now, not only is this market large, but it's also liquid. So let's take a look at the dollar transactions year to date through June 2018, and you see that China is second, once again, to the United States. So you have a sizable market, a liquid market, and these are two traits that we look for institutional portfolios. Now, one of the other reasons why we care about the A-share market are opportunities for alpha. If you look at the number of research analysts that are covering the individual stocks within this market, it's less than what you see in the United States. And this means that there's potential mispricing of stocks, which means that there's potential alpha for portfolios. So that is a little bit about why we care and maybe why they deserve some of our attention. Next, let's take a look behind the curtain and get a view at some of the characteristics within the A-share market. If you asked me to pick one word to describe the A-share market, the word that I would use is volatile. Take a look at the chart on the left-hand side. That's the rolling 5-year return chart. That dark blue line, that's the China A-share market. You see big swings in performance, high peak, low trough. Take a look at the chart on the right-hand side. That's a rolling 5-year standard deviation or volatility chart. You see the S&P 500 in the green line at the bottom. Above that is the emerging markets equity index in the orange line. And above that is the A-share market in that blue line. So historically, this market has been volatile. But with that volatility, the market has offered lower correlation. Now, correlation, this is a mathematical calculation that tells us how likely portfolio diversification exists when adding an asset class. So a correlation closer to 1, that means less portfolio diversification. A correlation closer to 0, that means potentially more portfolio diversification. So if you can take a look at that purple box, purple is my favorite color, and you see that the EM index has a 0.80 correlation to the S&P 500. If you move your eye gaze to the left, you see that the A-share market has a 0.35 correlation to the S&P 500. So there's a potential diversification benefit within the A-share market. Now, one of the questions that we ask ourselves is, why is this market so volatile? And certainly, if you compare this market to the United States, the S&P 500, it just doesn't have the history, the track record. It's a less mature market. In addition to this, if you look at the groups that transact and hold shares in this market, nearly 50% of the ownership is held by high net worth and retail investors in China. And these investors tend to be more trading oriented, moving in and out of stocks more frequently. The average holding period is less than 26 days. Now, one of the other issues to be aware of within the China market are trading suspensions. Trading suspensions are when a publicly traded company suspends trading on its shares and prevents investors from buying into or, more importantly, selling out of their shares. In 2015, we saw a spike in trading suspensions, nearly 900 of those that occurred during that time period. Now, since then, trading suspensions have come down over time as China's changed some of the guidelines and regulations. But into the future, we need to see this continue to move downward in order for groups like MSCI to feel more comfortable expanding their A-share universe. One of the other issues to be aware of within the Chinese market are state-owned enterprises. A state-owned enterprise is a publicly traded company where the Chinese government holds a significant ownership stake. Now, historically, state-owned enterprises have been a major part of the Chinese economy. State-owned enterprises account for 15% of the employment in that country, and they hold nearly 40% of the assets. Being that the H-share market represents that old Chinese economy and that old opportunity set, it's no surprise to see that H-shares have roughly 80% of state-owned enterprises. In comparison, the A-share market is much lower, somewhere below 40%. Now, in terms of sector diversification, the Hong Kong Stock Exchange is very concentrated. There's nearly 70% just in the financial sector. A lot of that is state-owned enterprises. In contrast, the A-share market is much more diversified across sectors. So with the A-share market, you have fewer state-owned enterprises, you have more unique investment opportunities, and more sector diversification within that market. So that's a little bit about what they look like and how they compare with the old opportunity set. So let's talk about the future. As I stated earlier, MSCI added a small piece of the A-share market, small piece of the universe, and it made up 80 basis points of the EM index, and that was at a 5% inclusion rate. Okay, so it's a small piece of A-shares. What would happen if MSCI went from a 5% inclusion rate to a 100% inclusion rate? A-shares would swell up to about 16% of the EM index. And this is larger than many of the countries within the EM index. You think about countries like Mexico, Brazil, Russia, they all have smaller weightings within that benchmark. The question is, how long is it going to take MSCI to move from 5% to 100%? At this point in time, they haven't provided any specific guidelines or timeline to answer this question, but we can look at history to give us an example to provide some framework for this question. So if we go back to 1996, that's the year I got my driver's license, you can see that Taiwan had a 50% inclusion rate and represented just under 9% of the benchmark. You fast forward 2004 to 2005, and Taiwan went to a 100% inclusion rate and made up just under 15% of the benchmark. So it took Taiwan 8 years to go from 50 to 100. Now, what does this mean for China? Well, it means that we're probably not going to see a 100% inclusion rate next year, probably not going to see it the year after that. This is something that's going to take 4+ years. So we expect to see this over the medium to long term. Now, one of the other things that we expect to see over the medium to long term is China's ability to keep its homegrown talent at home listed on their local exchanges. Right now, if you look at 3 of the biggest Chinese companies, most held Chinese companies, they all trade outside of China. Alibaba, Baidu, Tencent. Alibaba and Baidu actually trade in the United States. Now, as the A-share market continues to mature, as institutional investors across the globe continue to increase exposure, we would expect to see China's future stars be able to stay listed at home rather than having to play overseas. That's going to wrap up this flash talk on the China A-share market. I do want to leave you with some takeaways. Historically, U.S. investors have accessed China through the Hong Kong Stock Exchange that represents that old opportunity set. A-shares, they do have fewer state-owned enterprises, more unique investment opportunities, and better sector diversification. Those markets are large and liquid, but they are also volatile. We do expect the A-share market to continue to mature, to become a bigger part of institutional portfolios, though this is likely to happen slowly over time. The final point is that currently, we do not recommend a dedicated allocation to China A-shares, but we do think it makes sense to have some stock-by-stock exposure in a broader emerging markets equity allocation, as it can be a good source of alpha. I want to thank everyone for their time. Next up will be Ben Moore, who will help us decipher today's bond markets.